Okay, class, this is the third 15-minute interval, and we're going to pick up where we left off and quickly talk through the steps that an accountant will go through in the recording of entries on the books of a company. If you think about a normal process, and let's say purchasing some equipment for your business, there will be some transaction documentation. In the case of the equipment, it will be an invoice from the company that we purchased it from, a purchase order. Perhaps someone in your organization approved the purchase. It will also include the check that we used to pay for that equipment. That will then trigger a journal entry. The journal entry, of course, in this case, if we assume that we paid cash, would be a debit or an increase to the equipment account and a credit or a decrease to the cash account. Had we purchased that equipment on credit, the debit, of course, would still go to the equipment account, and the credit, of course, then would go to accounts payable. That journal entry makes its way into the ledger, which is the accumulation of all of our different journal entries. So if we were looking at the equipment account, we could see all of the transactions for a period that went in and out of that account, i.e. the debits and the credits. That then triggers or rolls up to the trial balance, which of course lists out each account and what our ending balance is, if it's a balance sheet account, or what the sum of all the transactions are if it's an income statement account. And from there, the trial balance populates our financial statements. Okay, there's a different process that one could go through dividing step 4, the trial balance, to an unadjusted trial balance, and then a journalized and post adjustments balance, trial balance. And the only difference between step 4A and 4B and step 4 up above is 4A, or 4B I should say, also has all of the adjusting entries in it, which are the transactions, of course, that we just went through. Recording of liabilities, recording of revenue, that and the like. Okay, so we're going to move on, understanding the process that one goes through for both implicit transactions, which of course, explicit transactions, which of course start with the transaction documentation, and the implicit transactions for which there is no transaction documentation, but for which the passage of time triggers that entry. From there, we're going to start to look at, and we've talked about this really from the very first class, a classified balance sheet, what it looks like, and how we begin to analyze that balance sheet. The balance sheet, as we've talked about from the beginning, is going to be grouped into subcategories, which of course are aimed to allow readers to gain perspective on how the company is performing, and also be able to draw attention to certain accounts that maybe look a little different from what one might think they should, or be able to compare it to other companies. As we know from prior discussions, the assets are classified as current assets, and a current asset is an asset which is either cash or which is reasonably expected to turn into cash in the next 12 months. And then you have your non-current or your long-term assets, which of course would be assets that would not otherwise be turned into cash over the next 12-month period. And then the same is true for your liabilities, where you have your current liabilities, which of course in this case would be liabilities for which you will need to pay with cash over the next 12-month period. And then your long-term liabilities would be liabilities that would be paid with cash outside of the next 12-month window. We've talked about current assets a number of times, and I think the important thing, outside of the fact that they're going to be turned into cash within the next 12-month period, they're also listed in order from which they are likely to be converted to cash. So of course, cash is cash. That would always be the very first item on your current asset side of the balance sheet. Accounts receivable is typically the next. Inventory is typically the third. Accounts receivable comes second because you've already sent out the invoice. You're now waiting 30, 45, maybe 60 days for the company, your customer, to pay, i.e. with cash. Inventory, of course, is next. You then need, because you need to sell that inventory, and it's at that point where you'll send out the invoice, and then it will get converted to cash. And then after inventory, you typically will have things like prepaid expenses, i.e. the prepaid rent that we've talked about earlier. Perhaps you have prepaid 4, 5, 6 months of prepaid rent. Of course, that's not going to be converted into cash, but the benefit of that asset may last 3, 4, 5, 6 months ahead. Current liabilities, of course, is the same thing, but on the flip side, your accounts payable will generally come first. Why? Because you're going to be paying those accounts payable in the next 30, 45, 60 days. You're going to be using cash to do that. You may have some accrued expenses. Perhaps there are some bonuses that the salespeople in your organization have accrued over the course of time for things that they've done. Several months out from now, those accrued expenses will convert into the actual bonus payment you make. Thereafter, you may have some, let's say you have some debt with someone that you've bought some equipment from. It's 3-year debt, and it's for $6,000 in total. So $2,000 of that $6,000 would be a current liability because it's due this year. The other $4,000 would be a long-term liability because it's due in years 2 and 3. The current portion of your debt typically will come after your accounts payable and after your accrued expenses. And then, of course, another account that we discussed earlier this evening would be our deferred revenue. Deferred revenue, similar to a prepaid expense, you're not going to be using cash to pay for that deferred revenue. Instead, you will be actually performing the services which allow you to record the revenue, and that typically will come after your accrued expenses. Most often that will come before the current portion of your debt. Working capital is an interesting nuance, and it's something that financial managers will evaluate. Working capital is effectively your current assets minus your current liabilities. And if you think about conceptually what that means, your current assets are your cash and the items that are reasonably expected to turn into cash in the next operating cycle or next 12 months. And your current liabilities would be the things that you need to use cash for over your next 12 months. So optimally, you want to be in a position where your current assets are significantly more than your current liabilities, which says that you have excess cash that you can use for other things over the next 12 months. If you're in a situation where your current liabilities, i.e. things that you need to use cash for, exceed your current assets, you're in a position where you need to think about how are we going to manage that? Is there a way that we can generate more current assets? Of course, one way to generate more current assets would be to sell more stock. But other ways may be to be able to figure out ways to be able to trim down your organization, and we'll get into that in the second half of this course. Format to the balance sheet we'll talk about, and the best way probably to talk about that is on a subsequent page with an example. The classified balance sheet we've looked at would be Google or Facebook we've looked at in class, but we're going to look at an example of a balance sheet right now. This is a typical balance sheet of what a company would look like. Of course, on the left side, you have your current assets. Cash, of course, is at the top. Your short-term investments, in this case, would be you have excess cash, and rather than just hold it in a very low to no interest-bearing account, you may put it into some conservative investment account that yields some interest. So that's almost equal to cash. Accounts receivable, for the reasons that we've talked about, your inventories, your prepaid insurance. In this case, there's actually some longer-term investments, both stock and the cash value of insurance. We don't need to discuss the cash value of insurance, but in this case, stock investments may be an investment of some excess cash that's locked up for more than a year. And so in this instance, it is a longer term investment, as it may not be able to be pushed into cash in the next 12 months, perhaps a certificate of deposit with a bank or something like that. Coming next would always be your property, plant, and equipment, any land that you may own, any building and equipment you may own, your accumulated depreciation, which of course is a contra account, reducing that. And then towards the bottom of your asset side, you're going to have your other assets and your intangible assets. Goodwill we'll discuss later, but goodwill is effectively the excess purchase price that you pay if you bought a company over what the value of the assets were. So if you were buying a company for $1,000 and they only had $500 worth of assets, you paid a premium to buy those assets. Consider that premium of $500 to be the goodwill. Other assets, a receivable from an employee, I would think if that would ordinarily be a current asset, but in this case perhaps it's a loan they made to an employee that's payable out in 4 years or something like that. And on the liability side, very, very similar. Accounts payable, we talked about, those are the accounts that we owe to our vendors in the next 30 to 40 days. Our salaries payable, perhaps they're due next month. Interest payable, we have interest, so let's say it's due every 2-3 months on a loan of some kind. We have our taxes payable, perhaps income taxes, perhaps real estate taxes, things like that. And then we talked earlier about what the current portion of the note is. In this case, it looks like they have a mortgage liability of $110, a note payable of $190, so $300,000 of long-term liabilities, and $40,000 of current portion. That would be the portion of that $300 that is due over the next 12 months. And then, of course, you also have your long-term liabilities, which we just discussed. And at the bottom, you have your stockholders' equity. Capital stock, which of course includes the value, the common stock account at par, and then your additional paid in capital. They would be bundled in. And your retained earnings, which of course we now know to be the cumulative sum of all of our income statement accounts from the very beginning of time. Interestingly here, if you look at $450,000 of current assets, $150,000 of current liabilities, this is a company that has $300,000 of working capital. And we're going to remember that number and remember those 450 and 150 numbers because we're going to talk about them in a little bit more detail. So the current ratio, we talked a little bit about working capital, which is your current assets minus your current liabilities. Your current ratio is just simply your current assets divided by your current liabilities. That's a way to help assess the company's liquidity, which of course is their ability to meet their near-term obligations with either their cash or their near cash assets. In the case of the prior balance sheet, with $450,000 of current assets and $150,000 of current liabilities, with $300,000 of working capital, that's also known as a 3-to-1 working capital ratio, meaning for every $1 of current liabilities, this organization or entity has $3 in assets to be able to support the payment of those. The higher that number is, effectively, the better, but at some point, if it's too high, perhaps that organization should be doing something else with those current assets to be able to drive more business for it. In this instance here, if the ratio is very low, in this case it's 3-to-1, but let's say it was 1-to-1, that may indicate some difficulty that the company has in meeting its near-term obligations. So, sorry, we had a little bit of a glitch. We're going to quickly go through this and then pause. So a low ratio, if it was at 1-to-1, may indicate, boy, for every dollar of current liabilities, there's only $1 of current assets. And a high ratio may, of course, mean that the company has excess current assets, and creditors should have a high degree of confidence that they'll be paid from the organization. We're going to pause here as we're coming up to the end of our 15-minute interval, and we're going to talk next about income statements and the preparation of those income statements.